Good morning and welcome to the Monday Call. I'm Stefan Clark, Chief Client Officer at NZ Funds, and with me is Mark Brooks, Principal and Portfolio Manager at the firm. Business, financial markets, technology, politics, they're ever changing and always evolving. To be successful investors, one needs to distinguish between the important and the interesting, the short term and the long term. One also needs to understand how human behaviour can shape financial outcomes. While it's not a widely known name in New Zealand, Northern Trust is one of the largest banking institutions in the United States and caters for corporations, institutional investors, and ultra-high net worth individuals. At mid-2022, it had roughly $1.7 trillion in assets under management and $17 trillion under custody. This week, we are joined by very special guest, Gary Paulin, Head of Global Strategic Solutions for Northern Trust's asset servicing business out of London. In his role, Gary is at the centre of global business and financial activities, routinely meeting with leaders of sophisticated investment organisations, including CEOs, CIOs, and other executives at global asset managers. Gary is also a regular author of Northern Trust's thought leadership article series, The Weekender and Outside in Thinking. Gary is also a Kiwi. Hi, Gary. It's really great to have you here, and we're very much looking forward to getting your insights on markets and where the world is currently at. But before we kick into, the heart of our conversation, I would love to hear a little bit about your journey from New Zealand to the Northern Hemisphere and your time in the markets.
Sure. Well, thank you very much for that wonderful introduction. That's possibly the best introduction I've ever heard, both of me and my employer. So thank you for that. My journey started in a little place called Clyde, New Zealand, where I was the youngest of 8 children. We grew up on an orchard, and I still have quite a lot of family who live around Central Otago. Whilst a lot of our neighbours were madly investing in grapes, we stuck to cherries, which I think is an investment lesson number 1, which is to stay in your lane and eventually things will pay off. I then travelled to Otago University, where I pretended to be a rugby player, managed to get some national age group success, but always knew I wasn't really big enough or frankly good enough to make a career out of it, certainly a long career out of it. And so I decided to use my brain instead, and I pivoted and became a barrister, or studied to become a barrister. I moved up to Victoria University in Wellington, played some club rugby up there, ended up in the New Zealand Universities team, and then somehow found myself on a plane towards the UK with a scholarship to go to Cambridge University, stopping off in Italy on the way to have a season playing rugby in Milan. So I guess my professional journey starts in the UK at Cambridge University. And as you can imagine, graduates from these UK unis are targeted. But especially the year I was graduating, because it was the dot-com mania and a raging bull market for equity. So I got lucky because recruiters were in full FOMO mode. They weren't terribly discerning. And it was a case of a rising tide lifting all boats. And I got caught up in the wash and in the mania, which I guess is an investment lesson number 2, not just for investments, but for business strategy. And that is, pick the tide and then just turn up. I was offered an internship on something called the equity sales desk at Merrill Lynch, and Merrill's at the time was known as the Thundering Herd. And I had no idea what an equity was, although I thought
it was the place to be at that point in time, wasn't
it? It was
the centre of the universe.
It was a machine. I think there was one stat: 3 out of every 10 stocks traded through US pipes went through a Merrill platform. It was a beast, and you might remember it because during that time it was infamous around the dot-com thing, and whilst I was there, we IPO'd pets.com, which was I think pretty much marked the top of the market. And It was really interesting because it was a lesson in certainly in hindsight, a lesson in narratives and the importance of narratives and how stories can sometimes, arrest the market logic and certainly the logic that comes with numbers. So I thought that was, I always look back at that and think, gosh, that was really, really powerful and quite a potentially interesting analog for the period we find ourselves in now.
Would you mind just for those on the call who didn't go through the journey of pets.com, just summarising, at a high level what happened?
Well, I think it was one of these businesses sold very much on a promise and not on any indication of profits. And given the state of the market at the time, the market was prepared to attract or to attribute a lot of value to those promises blindly. And I remember, it IPO'd, and I think it went up some. I can't really remember. It went up some extraordinary amount, but then that was it. Never saw those highs again. But that was a company that actually was based on a promise. There was a lot of other companies that actually generated a lot of income, and even they saw their valuations decline quite rapidly once that bubble burst. But it was just a very fascinating time to be involved and having a ringside seat at a bit of history. But things didn't stop there in terms of large market events. I was then offered a job on their MBA program, not having an MBA, see above Raging Bull Market, and I started my career, my working career, in New York on a rather rememberable day, which was September the 11th, 2001, in an office attached to the World Trade Center by a footbridge. So it was the first day in the office story that I think few will forget, at least I will. Merrill Lynch for 5 years, and then I met another Kiwi guy in London, a guy from Palmy North called Guy Gibson, who sort of caught me, and in a weak moment, he suggested I leave my cushy, well-paying job and set up a business, which we did. We called that Aviate Global, and it was a thematic research brokerage. The idea of the aviation metaphor was a nod to us thinking we could navigate through any storm, not realizing the storm we were entering was the world financial crisis. And in fact, true story, our first day of trading was July 17, 2007, 13 minutes from the top tick in the Euro stocks. And 5 years later, the Euro stocks had halved. The client we first traded with no longer existed. So it was an interesting time to be a broker, but it was a great time to build a business because we managed to, I guess, gorge ourselves on talent that I don't think would have existed if the market was going up. We eventually sold that business to Northern Trust in late 2016, and that's how I ended up at Northern Trust, which is where I now work. My job at Northern is principally, as you mentioned in your very good intro, is to travel and to talk to CIOs predominantly of our large asset owner clients. And the reason I do that is the more I can understand about their challenges, the better we can position some of our solutions. And what we've been recognizing is that a lot of their challenges no longer stop at cost and complexity, which is what asset servicing can solve for, but they extend to performance and returns as well. So my role now is very much an enterprise role that straddles both our asset servicing but also our asset management business. And I also write a weekly blog, as you mentioned, which is called The Weekender. And The Weekender, it's really just a summary of my own macro and thematic thoughts. It's very similar to what we used to write at Aviate, where we would try and identify key drivers and then consider the best ways of expressing those drivers in market. And this again is a nod to that idea that there really are only two things that drive markets and drive price, and one is numbers and the other is narratives. And as plenty of commentators focus on numbers, I thought, well, I'll focus on the narrative. And so that's the gap I spend most of my time. And I find writing really helpful because it helps me to understand the world, it keeps me relevant, I guess, and up to date. And importantly, it gives me currency to talk to CIOs, talk to folks like yourselves, and have a better understanding of some of the challenges you're going through. And if I have any goal from writing, is to force the reader to question, to challenge their own assumptions, in the hope of potentially improving their own decision making.
I think, Gary, one thing that resonates with us in your writing is so much of the market is about the here and now, but a lot of what you talk about is trying to step back and think about the longer term, and think about your inherent biases, the way you talk about, or the way people think. I thought it was interesting that you mentioned Jeremy Siegel's Stocks for the Long Run, something of a Bible in this business in terms of trying to avoid yourself and concentrate on what markets do well over time. Is there a background to that theme, or is it just sort of the way that you see the world?
There is certainly background to that. I think a lot of when I think about decision making, what is it that fund managers are trying to produce? What is your product that you're trying to make? And ultimately, it's a decision. So thinking about how those decisions are made and what lies behind those decisions, which as a human is, I think, really important. And when I think about how fund managers and allocators get their edge, I think solving for that human error could be the biggest opportunity left in markets. We seem to have exhausted a lot of the opportunities around gaining an information or a network edge. But I think there's a lot to do, or a lot more to do, around improving temperament, at least being aware of some of our bad habits and our human failings. I wrote recently about how I sold some of my AI stocks just too early, and I'm now wondering whether I should go back in. But there's a couple of reasons holding me back. The first is, the lived experience of a dot-com crash, loss aversion, as I think they call it, but also a cautionary tale of that great investor, Sir Isaac Newton. Do you know the story about Isaac Newton's investing success? Or rather, his perhaps the opposite of that. So Isaac Newton, not only a clever chap and discovered gravity, but he was also a great investor and the head of the mint, master of the mint, which is, I guess, equivalent to the governor of the Bank of England. And there's a great story about he invested very cleverly in what was the start of the South Seas bubble, got out well before the top, made a fortune, but then got FOMO and got back in at the top and lost a lot. And it's where he came with this quote where he can understand the movement of heavenly stars, but not the madness of man. And that's always struck a chord with me, and I'm always fearful of FOMO and getting back in at the top. So I'm slightly cautious. But the idea also, I think, of thinking about a decision-making process is really important. And if you look at if you study good decision makers, and it could be anyone, in our world, Munger, Peter Lynch, George Soros, or even in other disciplines like Charles Darwin, one of the things they share, one of the characteristics they all share, is they are very active in the pursuit of the counter argument. They always ask, where could I be wrong? And I love Charlie Munger's a bit of a hero of mine. I always love his idea about earning the right to form an opinion. And for him, that means knowing the counter argument better than the person arguing it. I see folks like Andreessen Howitz have a similar approach where they actually have a red team to go out and destroy an idea. And if the idea still manages to get through that process, then they invest. And I just think it's really important to stress test and to challenge, especially when you're committing risk capital, even more especially when it's not your own. So just learning some of those tricks that other good decision makers use and applying them to your own decision making, I think is very valuable.
I one of the things I love about your articles is how you clearly, openly wrestle with the challenge here and the human dimension. And a couple of things that really came through, particularly in your more recent ones, was this concept of sort of, optimism versus pessimism and the role of perspective taking. And you call it, or going to the balcony and detaching yourself from a decision. And then there's obviously the human biases, cognitive, emotional, which sort of come through. And I one that really stood out to me was you frame it as the value of naivety, which is this idea that I guess the exact opposite of how you were describing yourself before. Someone comes to look at a problem or a question without the baggage, and they tend to be younger people. You want to take us through and the value of bringing that into decision making. So avoiding loss aversion was the parallel you draw because of that naivety.
Yeah, it's so true. Just going back to your first point about this idea of going to the balcony, which I love. It's not my idea, by the way. It's from a chap called William Ury who wrote Getting to Yes, which is probably the best book on negotiation. Look, I think at times we are our own enemy. Well, I certainly am. So I'm speaking from personal experience. I'm my own enemy. I'm just a terrible trader, and it's all down to my emotions. We let our beliefs and our biases, judge our decision making, which we I think really need to try and avoid. And there's a great Bertrand Russell quote which has always struck me, and that is, "I would never die for my belief in case I was wrong." And I think it's times like this where emotion is very real, around things like AI, or the inverse of that is, China, right? AI, it's changing the world. China, conversely, is uninvestable. And I think it's times like that we need to get some perspective and step away from, the really emotive heat of the debate and do what William Ury calls going to the balcony. And what he's saying is let's not try and be a pessimist or an optimist, right? Because that's just simply too binary and nothing in markets is certain. Instead, become that detached observer and look at the situation as if it was a play. Right? I guess that's the go to the balcony point. And ask what's possible, right? Ask what if. Don't be deterministic about it. And I just find that really powerful. And interestingly, I think there's a relationship here to what some elite sports people do. And I think you mentioned, Stefan, you had Kieran Reid on your call recently. And I can't remember if it was Kieran, it may have been Richie McCaw, talked about, in the heat of battle, when they're under extreme pressure, you're down on the scoreboard. What they would do is they'd try and get perspective, right? And they'd try and get back into the present. I think Kieran would look out the stadium and McCaw would stamp his feet. Or maybe that was Dan Carr, I can't remember. But the point is they're trying to get that perspective. They're trying to get back to the present to enable them, to focus on the task at hand and just make better, more rational decisions. And I think that's really powerful. And, like elite sportsmen, I think some of the investors can learn a lot from that. And I think going to the balcony is one way to do so. In terms of the idea of the value of naivety, again, none of these are my ideas, by the way. But they are, there's no monopoly on good ideas, they say. Look, young people are human, so they're not unaffected by loss aversion. But in the case of the dot-com bubble and it's bursting, and assuming they're young enough not to have been scarred by 2000, then they have a completely different perspective, and they offer that counter narrative, one that I thought was actively worth seeking. They say that youth is wasted on the young, so I'm hoping not to waste it on the old, on me. And I mentioned earlier there was an AI stock I sold, and there was a couple of reasons why. The first reason is, if I'm honest, I really didn't understand what it did. Right, so the little money I had made had nothing to do with my skill and everything to do with luck. Right, so I got lucky. But the second was my lived experience, and those of my vintage was signalling caution. Right, I can't tell you how many times I was sent the brilliant interview between Howard Marks and Edward Chancellor. Edward Chancellor, I just think you should read everything he writes. He's fantastic, and Howard Marks, to be honest. I was sent hundreds of charts showing, Cisco overlaid with NVIDIA. And I just thought, look, the only way to get perspective here is to go to the balcony and speak to the youth. Annoyingly, I was expecting them to sort of, come back with all this hyperbole and all these crazy stories, the narratives. But I didn't get that. I got cold, hard facts. I got the numbers. And I got a book, by the way. I got a book called The Cloud Revolution by Mark Mill, which I found highly evocative because it created this picture where a combination of technologies, not just AI, but also distributed ledger, smart contracts, quantum computing, all of these things came together with new materials and new information and created this sort of new industrial revolution, or this unlock of huge economic potential. And they sort of equated it to the chrome-plated era of the Roaring Twenties. And that was, highly evocative. So it didn't really help me because, I'd sold out and here I am having to go through this process. So it's difficult. It's really difficult. And if I'm honest, I'm far more at home trying to get my head around real world pursuits like farming and building and construction, which by the way, could be where the real scarcity and therefore value lies. And it's probably where I'm spending more of my time now than in some of these more elaborate stories around AI.
I was going to say that coming back to those numbers can be often a real challenge. You can be a challenge as to whether it makes you buy the narrative or not, or actually you wake up to what is happening. From my own point of view, one thing I found instructive with NVIDIA is you look at their sales to data centers in 2017, 5 billion per annum. In 2021, it was 10 billion per annum. Yeah, so it doubled in 3 years. Stock then was about $350. Stock today is circa 800. So yeah, more than almost. Certainly more than doubled. Expectations for data center sales this year, $100 billion, 10x higher than 2021. That is, that's pause for thought in many ways.
Yeah, there's. What if it goes wrong? What if it goes right? And that's the thing, right? It's hard to forecast that far those kind of numbers.
But getting back to I suppose you're alluding to the UK housing market, and housing is always something which is dear to the heart of most New Zealanders. I think, again, too often the discussion here becomes very insular and talks about this market. But I think the UK and some of the stuff you've been writing about UK building patterns is really interesting and has some parallels here.
Yeah. Just before we mention housing, I just go back to your point about valuation. Because it's so temporal. People talk a lot about concentration risk, and they talk about these excessive numbers, valuations. To give some perspective, the way I think about the numbers is you can't, and I think you were alluding to this, Mark, you can't really think about the numbers without reflecting on the narrative, the story we tell ourselves. And if you believe, if the market believes that generative AI is going to be as big a thing as Victorian plumbing, which I think is I think the loo is the singularly most impactful thing on productivity that's ever been invented. Second to the automobile, right? The automobile improved not just productivity but also demand. Right? If you believe that generative AI is of that nature, then you could make an argument that the current concentration could go higher, because if you look back in history, you'll see that the transport sector, I understand, when that was a craze, actually attracted 60% of the market's valuation during that period. And then in terms of valuation, you mentioned Jeremy Siegel, who wrote Stocks for the Long Run. He also wrote a wonderful missive called Revisiting the Nifty 50, which, look, I'm not sure the Nifty 50 is a good comparison, right? 50 versus 5, but for the sake of simplicity, he'd argue that it peaked on 2 times the market multiple, right? I think it was, whatever it was, 45, 50 times the market multiple when it peaked in 1972. You compare that to where the current MAG, I guess we can't call it the MAG 7 anymore, it's the MAG 5, but they're only about 50% higher on a price earnings multiple, perhaps even a discount when you adjust for growth. So it really depends on the narrative, on the story that you tell yourself. But what I would say is the concentration around the market is certainly not without foundation, right? These platform companies are incredibly good businesses. They're massively profitable, and as Siegel argues, and I think shows quite convincingly, great companies deserve great valuations. It's a question of how high, and I'll leave that to you. As you know, I've no longer got a dog in the race, so I'm a passive observer, if you like. Property, I just think this is not solely a New Zealand thing. It's not solely a British thing. It seems to be a Western thing, where we have, and therefore it's a broader trend. And I think a lot of it's down to demographics. And just one demographic issue is we used to assume that retirees would eventually move into a retirement village, or they would downsize. And what's happening is they're not. Now, some of that's to do with the cost of transaction in the UK. That's particularly the case with stamp duty, but a lot of it's to do with the fact that older folks are not only living longer, but they're living more healthily, and they don't see the need to move, and so that just removes supply from that which would have otherwise been available to the market at a time we are seeing a lot of pent-up demand come back on stream from COVID, but also in countries like the UK, net migration. Australia is the same story. So I think there is some pricing tension, and it's purely driven by supply and demand. And until that corrects itself, I think the price mechanism will favour upside.
And it obviously has a broad, for the property owners, a wealth effect. And I remember in one of your articles you talk about there's clear optimism towards the particularly United Kingdom, and where it's from you and how its economy is evolving and improving. Is that part of it, that you think that demand for property is going to underpin broader expansion?
It's part of it, but my particular excitement as it relates to the UK is around the capital markets, and especially equities. And there's a number of reasons for that. And let's be honest, I've been on this call for a year, and it's been wrong. As I mentioned earlier, it's one of those markets only a mother could love. But nevertheless, I'm still convinced that on a 5 to 10 year view, there are a few better opportunities than UK stocks. And the reason I say that is they're cheap, they generate an awful lot of cash, and they're using a lot of surplus cash to buy back shares. And what that means is a lot of these companies, and there are a host of them that are buying back and retiring their their share capital at a rate of knots whereby you, as the holder of those stocks, are seeing your economic rights compound over time. Well, that's compounding in reverse. And it's a way of getting rich slowly. And I think it was the essence of what David Einhorn was saying last week. I don't know if you read his piece, but he's talking about how machines have broken markets, but there are other opportunities in value if the value is combined with highly cash generative firms that buy back their shares. So I think that's really interesting. And why I get even more comfort is that's my starting case. There is a chance, and it's a non-zero chance, that you get rich a bit more quickly if we see government reforms. And I believe we will. There's a lot of talk about pension reforms, a lot of talk about how do we inject more of a risk-taking culture in the markets by fixing the availability of capital, not just in private, but also in public markets. There's talk of increasing tax-free allocations to British stocks, for example. There's some talk of removing the stamp duty that is attracted to transactional volumes of UK shares, which is just a bit of an own goal, if I'm honest, in terms of the UK stock market compared to the US or the Australian market. So there's a lot of talk of positive reform. Whether that talk manifests in action, it's yet to be seen. But the valuations suggest, I'm quite happy being patient and waiting for this to occur, because, as I said earlier, the rate of buybacks are such that you can compound your wealth by doing nothing.
That's sort of an add-on to that. I think one thing that we find interesting talking with clients often, and we talk about sort of share exposures in different share markets, is often the view is that they're not particularly different, or at least at a very high level. But one of the, again, sort of echoing some of your points earlier, sort of for us, it's sort of trying to understand and ask the right questions as to, in the case of a share market, what do you actually own? And I think it's really interesting if you look at the different makeups. The UK is heavy financials, it's heavy consumer staples, very low tech. Much like, in a similar or in a different way, New Zealand's very heavy utilities and industrials, very low tech. If you get back to an environment where, probably banks are lending, banks are encouraged to lend, interest rates are lower, and you may have some structural reform at government levels around infrastructure, you could have a lot of positive tailwinds for those types of businesses over and above their incumbent sort of cash positions and etc.
100%. And it's interesting. There's we mentioned before that numbers can stay very low, and they need narratives to make change. We all know that things like commodities and are cheap, and maybe cheap for a reason, and they need a bit of a PR job at the moment. I think that PR job and that role of narrative and storytelling comes from a book that's just been written called Material World. Have you read that book? It's fascinating, because what it does is it sort of posits this idea that we all live in this ethereal world of services, of technology, of apps, and yet we perhaps don't appreciate the role that the material world plays to not only provide and sustain, but also, if we're going to transition to a greener world, help us get to that as well. And it uses storytelling to bring this idea to life. And it does one, I think, wonderful example of, it takes the journey of silicon in your mobile phone, and it asks, right, do you know where the silicon in your mobile phone comes from? That mobile phone that's produced by a good and green company. And the answer is, well, it starts its journey in a quartz mine in northern Spain, gets blown out of the ground using an explosive, very carbon intensive. It then gets smelted, probably using thermal coal. It then gets shipped around the world about 3 times. It goes through a number of really carbon intensive processes, one of which is 3,000 times more carbon intensive than producing steel. And that's before it gets to the fab in Taiwan, let alone your pocket. And so just bringing that idea to the surface, I think, is one of these stories. It's one of these narratives that could make people stop and think, well, maybe the scarcity isn't in, the IP. Maybe in the scarcity is in the supply chain, because there are certain links in the chain where there are only one or two companies that produce those processes or the equipment that goes into those processes. And indeed, there may only be one or two areas in the world that actually produces the raw material that goes into those processes. And so the question may become, well, if we're looking to invest in scarcity, maybe it's not in the chip manufacturer, maybe it's in some of these raw materials. And if that was to happen, then look at the proxies and look at the valuation of those proxies. You look at the US on, whatever multiple it's on. You look at countries like the UK, which has claims on lots of these more Victorian type industries, or Brazil. Japan also has a lot of exposure to the value chain of the productive capacity of these types of technologies. So I think the world is starting to wake up to some of these ideas, and I think this idea of mean reversion is very powerful, and that's why I'm spending a lot of time looking for the scarcity within that world. And I come back to house building, right? The world's short builders. Right? The world's largest shortage at the moment isn't dog walking app producers, it's spot welders. I think spot welding is the singularly biggest scarce resource on the planet. Side story, I for Christmas this year, I bought my children a broken motorbike, and I said to them, if they want to use it, they have to fix it, thinking that they are going to need these skills in future, and if they don't need them, at least they've got them. Because I think spot welding could be in demand, certainly more so than the ability to play on PlayStation 3. But I just find that whole idea quite fascinating, and it's not one that's sort of captured the imagination yet, but books like Material World can certainly help.
A couple of things in there, but one thing that stood out is you said numbers can stay low, and then obviously we touched on property and spot welders. In China, the numbers have stayed low, and there doesn't seem to be a shortage of spot welders. And property seems in abundance at the moment. Do you want to take us through the investment case there and how you can, I guess, draw distinctions between what's going on in the Western world and what's happening in China, and your views on whether it is indeed uninvestable or not?
Well, let me just preface this by saying this is not an investment case, but it's an observation, and it comes from the idea of going to the balcony and trying to get some perspective. Look, I think China's interesting for a number of reasons. The first is nobody owns it, right? And it's people are very underweight for reasons that I think we all well know. And when you think of your risk to a portfolio, often it can come not just from what you own, but also what you don't own. And when you don't own something, when you're very underweight, as is the case with folks around China, you really need to be able to point to new and incremental negatives to justify that position, in the absence of which you often find people just go, right, I'm going to take the bet off and move to market. And that mean reversion can be quite a powerful driver of price in its own right. That's the setup. Now, I'm not suggesting that's what's going to happen, but it's certainly something people need to consider, if only from a risk perspective. Now, if you think of China, you obviously have to consider whether, right, if all the bad news is in the front window, where could the incremental positive come from? And the question is, does Xi now see the importance of the economy as a way of driving party loyalty? I guess that's been his goal. And there's three routes to growth, I think, as it relates to improving the economy and wealth perceptions. The first is promoting entrepreneurship and business formation. The second, as you rightly point out, is property, particularly property price. And the third is equitizing the system and using the stock market. Now, as it relates to business and entrepreneurialism, I think if you're looking for signals, clearly there's some signal value in the fact that Jack Ma is back. which suggests that perhaps entrepreneurs are now friends and not foes, which is interesting. Change in respect to property markets is really important. And again, you make the point, supply and demand is real. But what's interesting is, China, it was their intent to deflate or diffuse the risk of a bubble overheating, I think. And they used a lot of the rhetoric around property is for speculation, is for living, not speculation. That's now been replaced more with signals of affordability, right? They've cut mortgage rates, so it's subtle, but it's worth noting. There's also efforts to promote lending against whitelisted projects, which I think has some teeth. And property is critical, as you rightly point out, because what it does is, if you fix property, if you fix housing, not only do you fix the collateral value and therefore confidence of people to lend or to borrow, but you also fix consumption. So property is key. And if they've stopped trying to break it, basically, then that's of note with reference to, if you're underweight, you need new negatives to justify that position. But it will take time, right? That's for certain. Where there's more chance of an immediate feedback is in the stock market. And we all know how evocative price can be, right? It's a really powerful thing, and we all know, we've all had experience of where a doom loop can turn into a reflexive cycle. Should prices start to rise, even if those prices are rising because of encouraged participation, and if that encouraged participation then encourages domestic buyers of stocks, then things can really feed on themselves quite quickly. And of course, then you'll start to hear the narrative around the fact that you've got, what's the number, 14 trillion in term deposits, which is 2x the SH comp, multiples of its free float, and many times that what the US has got in money market funds. So you can see how, narratives can change the numbers very quickly. And again, I'm not saying this is going to happen. All I'm suggesting is, for those that are very underweight, you need to be able to identify new negatives to justify that position, in the absence of which the risk is that you see a mean reversion trade and the market rallies for a time. That's all I'm saying.
Interesting. Is that view formed by your discussions with other investors globally? Have you talked with investors where you see a shift in tone? Or is it something that you're foreseeing coming?
It's yes was the answer. All of the above. A lot of investors have just shunned China. It's just been too hard for reasons you can totally understand. We're seeing a lot of indexes being created that are Xing out China. Customized indexes, emerging markets ex-China type structures emerging. But it's really just the observations that you can make from just looking at the markets. A lot of people ask, where do I get ideas from? Where do ideas from the weekender come from, for example? And it really is everywhere, right? It's from talking to folks like you. It's by observing price action, particularly anomalies, right? When things that shouldn't happen do, and when things that don't happen but should. I think that's a trigger, that's a signal to sort of, to really double click and try and identify what happened. And Chinese stocks recently stopped going down on bad news, which I found quite interesting. I try and read as broadly as possible and across a lot of different fields, and I think that's important, just to escape some of the groupthink that can emerge in markets, especially when it's quite emotive, like it can be with some of the themes that are ongoing at the moment. I'll give you one example of, as it relates to technology. I mean, the best magazine I ever read for technology ideas isn't The Economist or some of the tech periodicals. It's things like The New Scientist, which has been on generative AI, GLP-1 drugs, gene editing, CRISPR technology, and all these things for ages. And so I think that's a really good example of why you need to look outside the square to look back in, if you like. And I've always been mindful that breakthroughs and sort of innovation quite often come from the outside, new eyes looking on old ideas. And to give you an example of that in relation to medicine, I remember once asking the CEO of GSK in the UK, Glaxo, where their innovative ideas come from. I was expecting him to say, they've got the greatest mind in science, they're all out in this big laboratory near Maidenhead, and they come up with these great ideas. But he didn't say that. He said that their best ideas come at the cafe at lunchtime, where the girl from cancer research is speaking to the guy from vaccines, and they have these sort of Aubrey moments, these breakthrough moments. And the point he was making is that innovation often occurs at the margin of disciplines. It's by taking stuff from other areas and applying it to your own problems. And there's a great book, I think it's called Reach by David Epstein, which talks about this. And they also talk about sports, which is really fascinating. And those teams that have this learning culture, always looking for things they can pick up elsewhere. And I'm not a football fan, but I'm intrigued as to watch Manchester United over the next couple of years, now that they've had the investment from Ineos and from Sir Jim Ratcliffe, because you're probably aware that Ineos are involved with a number of other high-performance sporting franchises like the All Blacks and like Formula One racing, UK cycling team, America's Cup sailing, and indeed the fastest man over 26 miles. And what they do is, they bring the learnings and some of the understandings from different disciplines, and they apply it to solving some of their own problems, which I just think is fascinating. So, top tip, keep an eye on Manchester United for the Premiership over the coming years. Here's a fun fact for you. Do you know where Glaxo first started?
Tell us. I'd love to know.
Palmerston North, New Zealand. Yes, Glaxo, I think, could be one of our greatest ever exports, other than the flat white and the pavlova. And it started its day as an infant milk. Glaxo was an infant milk formula, which actually made some New Zealand farmers fabulously rich, who took their dividends in scrip and perhaps unwittingly sort of geared themselves into two of the most powerful forms of wealth creation, which is dollar cost averaging and compounding. So there's a fun fact for the week.
And now it's GlaxoSmithKline and is a behemoth in the UK.
Do you know another fact about Glaxo? Is at one point they had preferred supplier status for penicillin, I believe, in World War II. And at one point they controlled 80% of all penicillin production in the UK. And we're talking about markets and crazy moves. Not so long ago, Novo Nordisk, which is dominant in GLP-1 drugs, fantastic business, but it generated the entire market cap of GlaxoSmithKline in a number of weeks, which I found just fascinating. And it was one of those signals that one of those anomalies, I guess, that made me think, hang on a second, can this be right? Because if I was to look back and if someone was to ask me, what do you think the singularly most powerful medicine has been, or invention in healthcare has been over the past 100 years, sure, I think there's huge benefits from what these GLP-1 drugs can occur, and even beyond just fixing obesity and the heart-related issues associated with that. But surely penicillin must have been up there. And to think that this company could produce and put on the market cap of that business in a number of weeks, I just found staggering, if I'm honest. Notwithstanding it's a brilliant company, and I'm sure it continues going up, but I just thought that was an interesting statistic and one worth exploring further.
The importance of the narrative, perhaps.
Yeah, exactly that.
Or the here and now.
Okay. Hey, I'm conscious of time, and you're a busy individual, and thank you very much for joining us, Gary. It's been a really enjoyable conversation, and it's clear from how you talk and your thoughts that you've got a very wide spread of influences, be it individuals, books, and observations from prices and markets and so forth. And really appreciate you taking the time and sharing that with us.
Absolute pleasure. It's been a lot of fun. Thanks a lot.
Great. Have a nice evening, Gary.